Every real estate investor dreams of building wealth that lasts, the kind that grows while staying protected from unnecessary tax erosion. But here's the truth. Your returns don't just depend on what you earn. They depend on what you keep. And that's where smart tax planning becomes the difference between slow progress and strategic success. Today, we're diving into two of the most powerful tools that can dramatically reshape your after-tax results: bonus depreciation and cost segregation. They might sound technical, but by the end of this video, you'll see how they work together to help you preserve cash flow, unlock hidden deductions, and position your investments for long-term growth. Let's start by setting the stage, understanding what depreciation really means and why it matters so much in real estate. Every property, from a single rental home to a large commercial building, wears down over time. Roofs age, carpets fade, and fixtures eventually need replacing. The IRS acknowledges that gradual decline in value through something called depreciation, allowing you to deduct a portion of your property's cost every year. For residential real estate, this spans 27.5 years, and for commercial properties, 39 years. Now, here's where many investors miss out. Those deductions happen slowly, which means your cash flow improves, but only little by little. What if you could bring those deductions forward and free up that cash today instead of waiting decades? That's where bonus depreciation and cost segregation come in. Two methods that accelerate depreciation and put money back into your business when it matters most. Let's talk about bonus depreciation, one of the most impactful provisions in the tax code. Thanks to the One Big Beautiful Bill Act, real estate investors in 2025 regained the ability to claim 100% bonus depreciation on certain qualifying assets. In practical terms, it means you can deduct the entire cost of eligible improvements in the same year they're placed in service. No waiting, no spreading out over 15 years. So what qualifies? Things like new lighting, HVAC systems, fencing, parking lots, and interior finishes often fall under this category. Here's an example. Suppose you spend $100,000 improving your rental property, updating flooring, landscaping, and security lighting. Under regular depreciation, those expenses would be written off gradually over 15 years. But with bonus depreciation, you can deduct the full $100,000 immediately. That's real cash saved and reinvested, money that could fund your next acquisition or renovation project. Timing is crucial, though. Those assets must be placed in service within the tax year, meaning ready and operational. Missing that detail can cost you the deduction entirely.
Now that we've covered bonus depreciation, let's move to the real engine behind it: cost segregation.
Think of cost segregation as a deep financial scan of your property. It's a study, usually conducted by engineers and tax professionals, that breaks down your building into individual components: electrical systems, cabinets, flooring, even exterior paving. Why is this important? Because each component depreciates at a different rate. A cost segregation study reclassifies those parts into shorter recovery periods, 5, 7, or 15 years, instead of the standard 27.5 or 39 years. And that's the key. Those shorter-lived assets qualify for bonus depreciation. Let's take a $1 million commercial property as an example. A professional cost segregation study might find that 25% to 30% of that cost, around $250,000 to $300,000, can be deducted in the first year. That's not a loophole. It's an intentional incentive built into the tax code to stimulate property reinvestment and growth. It's also one of the most misunderstood advantages in real estate. Many investors skip it simply because they've never been advised to explore it. Of course, where there's opportunity, there's also responsibility. These strategies require precision. One of the biggest mistakes investors make is misclassifying assets. Not all improvements qualify for accelerated depreciation. Things like building additions or major structural work must still follow the traditional schedule. Another common pitfall is poor documentation. The IRS expects detailed evidence, engineering reports, invoices, service dates, and categorized asset lists. Without that, your deductions can be challenged even if they're legitimate. And finally, don't forget depreciation recapture. When you sell the property, the IRS may reclaim a portion of those accelerated deductions as taxable income. That's why exit planning matters as much as entry planning. Using a 1031 exchange to defer those taxes can keep your capital growing while you reinvest in the next property. The takeaway here is simple. These strategies are incredibly valuable when used correctly, but they must be managed with care and guided by professionals who understand the details. Moving on, let's connect the dots, because bonus depreciation and cost segregation aren't just isolated tactics. They're part of a broader tax strategy that supports the entire investment lifecycle. For example, you can pair them with qualified improvement property deductions for interior commercial renovations, or align them with a 1031 exchange to roll deferred gains into new projects while maximizing first-year write-offs on the replacement property. Let's put this into perspective. You buy a multifamily property, conduct a cost segregation study, and use bonus depreciation to create early deductions. Those savings allow you to invest in energy-efficient upgrades, which qualify for additional tax credits. Then, when you sell, a 1031 exchange defers your capital gains. Each move builds upon the last, forming a seamless cycle of tax efficiency that compounds wealth over time. That's not accidental success, it's strategic design. Now, let's talk about something that's often overlooked: the importance of specialized guidance. Most general accountants are excellent at compliance. They ensure your returns are filed on time and your books stay in order, but compliance alone won't maximize your savings. Strategic tax planning requires an advisor who understands how depreciation interacts with financing, cost recovery, and long-term exit strategies.
It's about connecting the dots between tax law and business growth.
That's exactly where a real estate tax advisory service steps in. At Gav Tax Advisory Services, we work with investors, developers, and property owners across Houston and Texas to integrate these strategies into their business models. Our team models after-tax returns, coordinates cost segregation studies, manages depreciation schedules, and helps ensure your documentation can stand up under audit. We go beyond filing. We plan, analyze, and optimize, so your portfolio isn't just compliant, but strategically positioned for sustained growth. So, as we wrap up, here's what it all comes down to. Bonus depreciation and cost segregation are not just accounting moves, they're business growth strategies. They allow you to control your cash flow, enhance your liquidity, and reinvest faster, all while staying compliant and transparent. But like all powerful tools, they work best in the hands of professionals who know how to wield them. If you're serious about scaling your real estate investments and want a strategy that protects your earnings while positioning you for the next opportunity, it's time to take the next step. Visit gavtax.com to connect with our team and see how these strategies can work for your portfolio. See you in the next video.